Hello. Welcome to our most important chapter of DT, that is PGBP. Category A chapter, for sure you have to do this. So let's start. Okay, so PGBP is your next head of income. We have already done IFOS, we have done capital gain. Next is your PGBP. Okay, now PGBP, first of all, your most important section comes your 32.1.2, that is your depreciation. Now depreciation, basically they have divided all your assets into four block of assets. Your four block of assets being, first is your building, second is your furniture, third is plant and machinery, and fourth is your intangible assets. So all your assets will come in either of them. Now they have told you what rate of percentage will be for each asset. So any residential building will be 5%, any non-residential building will be 10%, and any temporary erection will be for 40%. That is temporary erection, any huts or anything you create for the purpose of creation of building, those will be temporary erection. So those will be depreciated at 40%. Residential building will be at 5% and non-residential will be at 10%. Okay, so building part is clear. This is your first. Second is your furniture. Your furniture and fittings is at 10%. How many letters do you have in furniture? FURNITURES. Furniture has 10 letters, so furniture has a rate of 10%. Remember this, furniture has 10%. Okay, next is your plant and machinery. Now plant and machinery is a little complicated, so be careful. Now any motor vehicle, if it has been acquired and put to use between this period, remember it is a very shitty date, that is 23rd August 2019 to 31st March 2020. If it has to be acquired and put to use, both of them have to be done in this period. Only and only in such a case you will get a 30% deduction. Otherwise it is usually 15%. So only and only if it is between 23rd August 2019 to 31st March 2020, if your motor vehicle was acquired and put to use in this period, it is 30%, otherwise it is 15%. And if your business is about hiring, if it is used in the hiring business, then you will get an additional 15%. Sir, will we get additional 15% over 30%? Yes, you will get 45% reduction. So 45, this will become 45 and this will become 30%. Okay. Any other plant and machinery includes mobiles and EPABX. Now EPABX are basically your landline phone. For example, your societies must be having intercoms, so those are your EPABX. So any other plant and machinery which includes mobiles and EPABX is your 15%. Remember, it is your favorites, ICI favorite word EPABX, that's why I put this over here. So that will be 15%. Okay, so your mobile phones come for average around 15,000, so your depreciation rate is 15%. That's how you will remember. Furniture is 10%, building is 5%, if non-residential it will be 10%, temporary erection will be 40%, furniture are 10 letters, so it is 10%. Great. Your ships and vessels rate will be 20%. So I'll clear it so that it is easier to read. Okay, so your ships and vessels percentage is 20%. Okay, great. Now your computer software, printer, scanner, books, aeroplanes, windmills, pollution control equipment, all of these items were once upon a time, very long point of time, they were 100%, which have now been slashed to 40%. So your highest rate of depreciation is 40%. This temporary reduction was also once upon a time 100%, which have been slashed down. Okay, so these are 40%. This you don't have to remember, do not confuse yourself. Okay, and last is your intangible asset, that is asset that you cannot touch. Ind AS is also covered in that. So any know-how, any patent, copyrights, trademark, franchises, all of those are 25%. Okay, sir, why have you cut goodwill over here? Because once upon a time you also used to receive depreciation on goodwill, but income tax they came up with an amendment that was there will be no depreciation on goodwill. Therefore, I have cut goodwill. So remember, there will be no depreciation on goodwill. Goodwill cannot be depreciated. So that is your 25%. Okay, now let's read points about depreciation. Now first of all, your depreciation will start when you put to use. Your depreciation claimed from when asset is put to use. Second is depreciation is claimed by beneficial owner. So even if you are not the actual owner, even if in the papers, even if in the books you are not the actual owner, you have taken it on rent. But if you are the beneficial owner, you can take depreciation of it. Third, depreciation is on WDV basis. There are two ways of calculating depreciation, either SLM or WDV. So depreciation is on WDV basis. However, some people have an option for SLM. So however, businesses which are in power generation or power distribution, they have an option to choose SLM basis, and they will have to do it on an individual asset method. They do not have this block. So if you are doing SLM, you will have to do individual asset method. Okay, or they can take WDV, that is up to them. So if they are taking WDV, they have to follow these blocks. Okay, only for power generation and distributors. Then next, if a lesser claims depreciation in case of leased asset, that is the lesser claims depreciation in case of a leased asset. Who is the lesser? Lesser is the person who gives the asset. He is the lesser. Who receives it, the lessee. Now, why is the lesser, even though he is not using the asset, why does he get the advantage of depreciation? Because the lessee is paying rent. The lessee is paying rent for the equipment. So since lessee is paying rent, he will show it in his P&L and he will get a deduction for the rent part of it. So since he is already getting deduction for the rent part, the depreciation part is given to the lessor so that both of them can benefit. And lessee does not get double benefit, that is one of rent and second is of depreciation. Any asset to be added back to be block even if not put to use, that is you have to depreciation claim from when asset is put to use. So asset to be added to block even if it is not put to use. Great. Then next is WDV of block cannot be negative. WDV of block cannot be negative. What does this mean? That your WDV will go at the max 0. Anything if it goes below 0, you will either be charged with you will be charged with short term capital gain. Okay, it will always be short term. In case of depreciable assets, it will always be short term. There is no option of having a long term capital gain. Okay. Then next is your half rate. Okay, if so there is a concept in income tax. If you use the asset for less than 182 days, then you will get half rate of depreciation. So I have already calculated the date for you, that is 4th October. So that is if half it, you will get half rate of depreciation if it is put to use on or after 4th October. So you have to calculate from 4th October to 31st March. So if it is put to use on or after 4th October, you will get half rate only if it is acquired in the same year. Like what if it was acquired in the previous year and put to use in this year? Then in such a case it will not be half depreciation. Only if acquired and put to use are in the same year and you have used it for less than 180 days, that is your 4th October, only in such a case your half rate of depreciation will be done. Otherwise you will get full rate of depreciation, and next year onwards you will always get full depreciation. Only for this current year you will get half depreciation. Okay, any new plant and machinery other than transport vehicle acquired and installed which is not in office, that is first of all it cannot be transport vehicle and it cannot be acquired in office by goods manufacturer, electricity generator or distributor will get extra 20% depreciation. Okay, so only if it is a goods manufacturer, electricity generator or distributor. Then second condition is it should not be installed in office, and third is it should not be transport vehicle. These people will get an additional 20% depreciation. Okay, next, if amalgamation demerger, then you will apportion depreciation based on number of days used by both entities. So first what will you do? You will calculate the total depreciation, then you will proportion them on the basis of which entity has used for how many days. That is how you will apportion the depreciation between both the entities. Next is short-term capital gain or short-term capital loss. As I told you, there is no concept of long-term capital gain or long-term capital loss. If your asset goes negative, that means if your asset goes below 0, so it will reach 0 and the balance amount will become your short-term capital gain or short-term capital loss. So got it? So when number of assets in block is 0 or when fair value of consideration is greater than WDV of block, that is suppose for example the WDV of your block is 100 rupees and you sold your assets, say for example 120. Now there are no assets in the block. So in such a case, when your fair value of consideration is greater than WDV of the block, even if there were assets, you would still have a short-term capital gain of 20 rupees because your fair value of consideration is much more than your WDV of the block. And when number of assets in the block become 0, so for example, you had 3 assets and you sold all 3 of them at a profit. So in such a case, you will have a short-term capital gain. Got it? So either your assets will reach 0, that is number of assets will reach 0, or your fair value of consideration will be higher. Your fair value of consideration will be higher than the WDV of block itself. WDV is nothing but it is as good as the cost of the block that is currently there after depreciation. Okay, if goodwill is already in block, so this is because of amendment. If goodwill was already there in your block, you will have to subtract the cost of acquisition minus notional depreciation from the block. So you will have to, any notional depreciation you will have to give, and you will subtract it from the block, so that you will remove goodwill from your block. Got it? Okay. Now next is your 33AB and 33ABA. 33AB is for SSEs who are growing tea, coffee or rubber. If your SSE is growing tea, coffee or rubber, he comes under 33AB. And if he is producing petrol or natural gas, he will come under 33ABA. If you want, you can pause the video, learn the depreciation rates and then move forward. Okay, so if he's growing tea, coffee, rubber and he deposits within 6 months from the end of previous year or due date of ROI, whichever is earlier, if he deposits how much actual deposit and 40% of actual actual deposit or 40% of your PGBP income in NABARD account, then in such a case he will get a deduction of that amount. It will not be considered as PGBP income and he will get a deduction. And in case of 33AB, that is if the SSE is producing petrol or natural gas, if it deposits by end of the previous year, actual deposit or 20%, remember over here it is 40%, over here it is 20%, to the site restoration fund. In such a case, if they transfer this amount, they will get a deduction. Now utilization, so they will transfer it to a separate account and later they can utilize it, but they cannot utilize it in office. That is not allowed. They have to use in same year when withdrawn. That is from the year when they have withdrawn from that account, they will have to utilize it for the specified purpose. Only then will they be allowed the deduction. And the asset that they have purchased, they cannot sell. The amount that they have withdrawn from this account, which account? NABARD and your site restoration fund account. So the amount that they have withdrawn from this and any assets they have purchased using this, they cannot sell within 8 years from the end of previous year in which they were purchased. That is, you will have to use this asset for the specified purpose. If they sell it, this deduction will be withdrawn. So that is the 33AB and 33ABA. Okay, now next is your 35ABB, that is lease to operate telecom services or spectrum. That is, for you have to apply for leases, you have to pay a very heavy amount. So it has to be amortized from the previous year in which license fee is paid till the previous year in which it expires. That means, for example, it can happen that the license fee that you have received for this telecom, it might be only for 10 years, but it might be spread across 11 years. How can that happen? Suppose I got my license fee on 1st June 2011 for 10 years. What will the date be? It will become January, February, March, April, May. That is 31st May 2021. So if you see, this is actually spread across 11 years, even though it is only 10-year license fee, but it is spread across 11 years. So for example, your original cost was 100. WDR after 2 years will become 80. And then you sold it for 150. So you have a total profit of 70 rupees. Now how will you bifurcate this 70 rupees? 70 rupees, out of the 70 rupees, your 20 rupees will be PGBP and capital gain will be 50 rupees. But sir, how did you calculate this? How do you know? So see, since you sold it for 150, that is 150, you compare with your cost. This 150 you compare with the cost, that means 50 rupees, so we are earning capital gain. The other 20 rupees is PGBP. Why? Because you have charged this 20 rupees to depreciation over a 2-year period. This 100 came to 80. How? Because you charged 20 rupees depreciation in PGBP. So we are only reversing ki boss, this 20 rupees that you have charged as PGBP, you are reversing, you are treating it as PGBP income now, and the rest 50 rupees will become your capital gain income. Okay, I hope this is clear. And your short term or long term will depend on the period of holding. Got it? If you want, pause the video, understand how this 70 has been broken up, why 20 and why 50. Okay, and then there are some cases as to how to calculate your cost of asset. So now to calculate cost of asset, if the asset is used for scientific research, the asset was used for scientific research, but it is now used in your regular business, your cost of asset will become nil, because scientific research, they give you 100% deduction for the asset itself. So since you've already received your 100% deduction, your cost will become nil. Any asset acquired by way of gift or inheritance, the cost will be cost of previous owner minus any depreciation allowed. Any asset purchased and leased back to the same person, that is, for example, you purchased an asset, okay, then you sold it to me, then I again leased it back to you. So what did you get when you sold it back to me? I gave you some money, you got some amount capital, and now you will give me monthly payment. So you bought an asset, you sold it to me, and then I again leased it back to you. In such a case, the cost of asset will be the WDV of the original owner. Now next is building used for personal purpose, which is now being used for business. That is, originally it was for personal purpose, now we are using it for business. So in such a case, your cost of asset will be your original cost minus notional depreciation. Original cost means when I had purchased it for my personal purpose. For example, I had purchased it 10 years ago. So now 10 years ago, the cost that I had incurred minus I will subtract the depreciation for 10 years, and that will become cost of asset for the business. Okay, if my holding company transfers any capital asset to 100% subsidiary company, remember this is not a transfer as per capital gain. So cost of asset will be WDV of transfer, that is for the new company. So that is whoever is the receiving company, the cost of asset for them will be WDV of the asset in the books of the transferor, that is the person who gave them. Their WDV will be this person's cost. Remember this, they have questions on this also. Okay, what is cost of asset? What all has to be included in cost of asset? So in your cost of asset, so first of all, your cost of asset itself, any installation charges, transportation expenses, any test run expense that you incur will also be added. Any taxes will also be added if ITC on them is not available, that is you will not get a credit. Any interest up to put to use date, interest only up to put to use date will you receive. You will subtract any sale of trial run product, that is while trial run, if you produce any product and you sell them. So since test run expenses were also added, so any income that you gain from test run will also be subtracted. Next is any subsidy or government grant received, that you will have to subtract. Do not include in cost if any payment per person per day exceeds 10,000 through modes other than account pay, check, DD or electronic clearing. That is, if I have made any payment to any person, suppose I paid installation charges, I paid you 40,000 in cash. So since I've paid you 10,000 in modes other than specified, I will not be allowed to add this expense. I will not be able to capitalize it, because they want ki boss, please use these methods to make these payments. So if any payment I have made greater than 10,000, they will not allow me to add it to my cost of asset. Okay. Now I have made a one-page summary of all the items that are allowed, all the items that are not allowed, so that you can do this while calculation of your sums. Everything is included. All your questions, and so I've tried to include as much as possible. So this I will be covering in another video, another short video. Right now we will skip this, and for those of you, you can watch this video and then you can watch the next video with regards to PGBP adjustments. Okay. Now your next is your 35, that is expenditure on scientific research. Expenditure on scientific research. So in-house research, any in-house research that you do, that is within your own company, if it is before commencement of business, that is your business has not yet started, so you will be allowed expenses of only 3 years before commencement. That is, any expenses made more than 3 years before commencement of business will not be allowed. In revenue expenses, only salary and material expenses will be allowed. Only salary and material, no other expenses will be allowed. And capital expenses, you will always be allowed 100% irrespective of whenever you incurred. But revenue, you will first of all get only 3 years before commencement of business, and you will get only for salary and material only. If after commencement of business, of course you will get everything. You will get revenue, everything. You will get capital, everything. Not an issue. Okay. Then depreciation is not allowed. Since you are getting 100% deduction, how will they allow you any depreciation, since 100% of your capital has been allowed as deduction in capital expense? So therefore you will not get any depreciation. Capital expense does not include land. Over here, when they say 100%, this 100% does not include land. That is, you will not get any depreciation for land. You will not get any You will not get any expense reduction for expense on land. In case of contribution to research association, institute, college, university, laboratory, company, you will get 100% deduction. If you make any contribution to research association, if you make any contribution to them, you will be allowed 100% of deduction. Earlier there were 150%, 100%, 200%. Now they have made it simple. Outside is 100%, inside is also 100%, and only this condition is a little that you have to remember. Otherwise everywhere it is 100% for scientific research. Okay, next is a preliminary expense. Preliminary expense is all the expenses that you do before setting up a business. That is any feasibility study report, any market survey, any legal fees. All of these will be considered as preliminary expenses. How much of those are allowed? Your actual expenses or 5% of your cost of capital, whichever is lower, that will be allowed as deduction. That is actual expense or 5% of cost of project. It will be higher of cost of project or capital employed for Indian companies. That is, if it is not an Indian company, it will only be cost of project. However, if it is an Indian company, then they will get an option for get higher of cost of project or capital employed, whichever is higher. That is uska 5% they can use as deduction. Next is your 35 CCC, that is agriculture extension project, or 35 CCT skill development project. Both of them have the same, so I have clubbed them. So 100% of your revenue and capital expense reduction will be allowed. And over here, capital expense, when we say 100% of your capital, we mean 100% will be allowed, but capital expense does not include any land and building. Land and building will not be land and building, you will not get a deduction. So remember, over here you have both land and building, both of these are not allowed. But over here it does not include only land, that means building is included. That means over here you will get deduction of building, but over here you will not get deduction of building, you will neither get deduction of land. Clear? Okay, now next is my favorite part, that is your 35 AD specified businesses. So they have mentioned 14 businesses which have been special businesses. So in case over here, if you do any investment, if you do any expenditure, 100% of your capital reduction will be allowed. But remember, over here also land is again not allowed. So land is not allowed anywhere in your capital reduction. Only in this section your building is also not allowed, that is 35 CCC and 35 CCDT. Over here building will also not be allowed. Otherwise usually in capital expense everything is allowed except land. Okay, your plant and machinery should be new, 20% can be old, that is okay. Your special business loss can be set off against special business income for infinite years. That is, there is no limit as to how many years you can carry forward. SB is your special business. Okay, all benefits claimed to be reversed if asset is not used in special business for a period of 8 years. Okay, so now we will understand what are specified businesses is. So specified businesses, first is warehouse of agricultural produce or sugar. So basically these are actually your two businesses. I have clubbed them in the ones since it is easier to learn. So warehouse of agricultural produce and sugar are both specified business. Any cold chain facility, any fertilizer, beekeeping and production of honey, pipeline for natural gas and petrol, slurry pipeline for iron ore. Then these are again two. First is your housing project under slum development scheme, and second is your affordable housing. So any housing project under both of these will be as a specified business. Hospitals with minimum 100 patient beds will also be included. Any two-star hotel or above, any hotel which has 2 star or above will be a specified business, because government wants ki people invest in these businesses. That's why government have given them a special criteria. Then infrastructure facility, any semiconductor wafer manufacturing unit. So this is basically your motherboards. And last is your ICD or CFS, that is your inland container depot or your container freight station. So for all of these are your specified businesses. So okay, so this is clear. For all of these specified business you will get 100% capital reduction. Land will not be included, remember that. Okay, now next and our last part of our chapter is your maintenance of books of account, that is 44AA. Who has to maintain books of accounts? So some specified professions have to maintain books of account, that is interior decorator, accountancy, legal, engineering, film artist, your company secretary, technical consultant, architect, medical, if their gross receipts, remember these signs, exceed 1.5 lakh in all three previous years, that is in all the three previous years, their gross receipts have to exceed 1.5 lakhs. If even in one of the year it does not exceed, they do not have to maintain books of accounts. So only and only if in all three previous years, remember the word is all three previous years, it is not any. So if in all three previous years the gross receipts exceed 1.5 lakh, they have to maintain books of accounts. Okay, and for other businesses, if their PGBP exceeds 1.2 lakh or their gross receipts exceed 10 lakh, it is an or, remember either of them and any of the year. So either your PGBP income exceeds 1.2 lakh or your gross receipts exceed 10 lakh, either of them in any of the three previous year. This is for businesses, and for individuals and HUF this limit is 2.5 lakh and 25 lakh. Okay, so this 1.2 lakh will become 2.5 lakh and gross receipts of 10 lakh will become 25 lakh. If for individuals and HUF, if they cross these limits in any of the three previous years, they will have to maintain books of accounts. Okay, clear? Okay, now next is your audit of books of accounts. Now 44AB talks about audit of books of accounts. So if the business's turnover in previous year is greater than 1 crore, or in case of, so this is your business, that is if turnover exceeds 1 crore. If you are in profession and gross receipts in previous year exceed 50 lakh, then you will have to get your books of accounts audited. Or if some person under 44AD or 44ADA, what are these are your presumptive taxation, which we will study below. If they claim that their income is less than 6%, 8% or 50%, these rates are given below. If they claim that boss, our income is actually less than this, then they will have to get their books of accounts audited, because income tax has given them a special provision ki boss, you can pay tax at the rate 6%, 8% or 50%. But if they feel ki boss, my income is actually even lesser than that, then they have to get books of accounts audited. Now remember, this 10 crore will be read as this 1 crore will be read as 10 crore if their cash receipts or payments are up to 5% of total receipts or payment, which means their total receipts or the total payments are only 5% in cash, rest all is digital. That is, if they are up to 5%, then they do not have to get books of accounts audited up to 10 crores of turnover. That means this limit of 1 crore will be increased to 10 crore if only maximum 5% of their receipts or payments are in cash. Okay, now next is the presumptive taxation. Now presumptive taxation is only available to your individuals and firms. It will not be allowed to LLP. Your presumptive taxation 44AD, the one that we just studied, 44AD and 44ADA, these are your two sections, 44AD and 44ADA. Okay, so your 44AD talks about gross receipts. 44AD is first of all for businesses. So if the gross receipts are less than or equal to 2 crore, carefully, if the gross receipts are less than or equal to, only then will they be eligible for 44AD. That is, if the gross receipts are less than or equal to 2 crore, they can choose 44AD, and their PGBP income will be either 8% or 6% of your gross receipts. 6% is, of course, if you are okay, so it will be 8% or 6% of gross receipts. Now 44ADA, that is your profession. So for them, gross receipts, if it is up to 50 lakhs, they can choose presumptive taxation under 44ADA. 50% of gross receipts will be your PGBP income. Remember, this is not your tax, this is your PGBP income. Tax will be calculated separately using slabs. So 50% of your gross receipts will be considered as your PGBP income. In the same case over here, in case of 8% and 6% also. And they are not required to maintain books of accounts or audited. But if they feel ki boss, my income is even less than 8%, then in such a case they will have to maintain books of accounts as we studied above. Okay, next is your 44AE, that is your transporter. So transporter, if his number of vehicles during during the entire period of the year should be maximum 10. If even for one day he had 11 vehicles, he will not be eligible for 44AE. So number of vehicles have to be less than or equal to 10 all throughout the year. His PGBP income, how much will his PGBP income be? So there are basically two types of vehicle. One is your heavy goods vehicle and your other. So heavy goods vehicle will be 1000 per ton per month. This is how much will be his PGBP income. For others it will be 7.5k per month, that is 7500 per month. So remember, over here it is per ton also in the high goods vehicle category, heavy goods vehicle category. Okay, next is your 44B, that is shipping, and 44BA, that is aircraft. So in 44B it will be 7.5% of rupees received in India, plus if the vehicle's destination was starting in India, that amount into 7.5% will be for shipping, and for aircraft it will be 5%. So 5% for aircraft and 7.5% for shipping. Okay, with this you are done with your presumptive taxation, and last part is your branches of foreign company head office expenses. That is, if any foreign company head office expenses are there, so how much expenses will you allow? That will be 44C, lower of 5% of adjusted total income, that is before brought forward depreciation, loss or any successive deductions. 5% of that or expenses attributable to head office, that is the branch says कि boss these are the expenses that are attributable to head office, whichever is lower, because the head office will charge them some expenses, right? And India will not allow to charge a lot of expenses, otherwise they will not be paying tax over here. Therefore we have to put a limit. So 5% of adjusted total income, or how much expense they say it is attributable to head office, whichever is lower, that will be allowed as deduction. And section 9b, section 9b was an amendment. So any stock in trade transferred by firm to a partner, so when a firm is dissolving, if it transfers any stock in trade to the partner, the fair market value of asset will become PGBP for the firm. That is the fair value market of the asset that they have given to the partner, that will become PGBP income for the firm. And with this we are done with PGBP chapter, but remember to watch the other adjustment video that I have uploaded. Okay.